Afternoon, everybody. Today is Thursday, May 22nd. I'm an associate member of T3 Trading Group, which is an SEC registered broker dealer, and member of FINRA SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. There is the position disclosure, pretty much the same as yesterday. I'm tired. Oh man, I kind of crushed this CRWV today, but it was an adventure and it wore me out. Um, I usually wake up at like between 3 and 4 local time on mountain time out here, which is 5 to 6 Eastern, and then I pretty much get started right away. Turn on the coffee, and then while it's brewing, I'm up here seeing where my positions are. But today, I woke up at like 1:55, and I was like, man, I'm tired. I should go back to sleep. And then 2 o'clock hit, and I was still up, and I just kind of like grabbed my phone real quick. And I said this in the morning meeting. I kind of broke one of my rules. I don't really do this. But I was like, let me just grab my phone real quick and see where the futures are. So they're up like 0.2%, and I was like, let me get a quote on this core weave at 2 a.m., 4 a.m. Eastern, just because I swung some short overnight. See where it is because it was so strong yesterday, and I saw that it was trading at like, I don't know, 116 or something like that. And I was like, oh no, that's not good. I'm going to be down a bunch of P&L. And now I'm awake. So I got up at 2. I was logged in by like, I don't know, 10 after 2. And I couldn't get a borrow right away, actually, which was interesting. And probably not terrible. It ended up being okay because I was able to get a borrow at the right time. Um, by 4:20, the borrow came in, and I started shorting it, and I was able to short. I shorted like a lot of stock. Um, between this is why I'm so tired. This is my core weave executions, including the pre-market. You can just see me just shorting pretty much the hell out of it here. So prices everywhere from like, I don't know, 117 quarter down to like 116 or so. Just the spreads were wide. It was really early in the day. Someone was driving this thing up. It was funny. Dennis at a certain point when it popped back up here, like 10:45 or whatever, he's like, "There's a pre-market supply zone at like whatever that it's approaching," and I was like, "I'm the pre-market supply zone." It was literally me this morning. Like coming on the offer, kind of like strategically doing what I can to get filled. I wanted the stock, but also like to kind of try to drive it down, and it was illiquid at that time. And ended up getting a lot of stock up there and traded it like a maniac all day, and it closed poorly. So, um, kind of ended up crushing that one, which was good. I needed that. It was good for the confidence. But it was a day 5 RDR to the upside, gapping above yesterday's high after that big buyer was there. Uh, you know, Closed really, really, really strong yesterday. Um, so yeah, luckily for that supply zone. Um, so this was like kind of my number one idea of the day, even in the morning meeting when it was already trading a little bit lower by the morning meeting, and it ended up being a really hard trade because it did pop all the way back up to 116 and change if you were trying to trade it and had like a 110 price or something, which I think would be a good price on the way down on that initial opening down move. Like I like the idea of hitting this thing, even if you hit it right here, 109.50, 110 versus this opening high as the downside momentum was coming in. I like that trade a lot. We were talking about the importance of 105 when it got down there, and it broke it, and you could see all like the stops go off or whatever below that 105 that it was trying to support, but then it tailed back above it, and I was like, oh man, they might run this thing again off this failed break of that 105, and sure enough they did. They really brought this back up to highs. Luckily, I had such good pricing pre-market that I never was in too much of a danger. Though I was certainly unhappy when it bounced from 104 to 116 and seeing the P&L shift from that move. But then it broke lower and it weakened out, and the day 5 up with the extreme extension on this thing held. It's like I said, this is just a trade for me. I'm not here to hate on the company or hate on the stock or whatever. It's just a huge upside move in a short period of time with a massive amount of extension with increasing volume. This is kind of just a recipe that I like, especially if they can move heavily during the day, so I can implement some of my kind of cash flow trading approach to it, and it worked out. So I still have some short, but I have fifth of my position left, something like that, and I'll be all out. I'm pretty sure by 95. So see if I can get a little follow through on the push through failure on this core weave tomorrow to make a few bucks. Though I wouldn't mind if it traded kind of like it did, preferably at lower prices for most of the day tomorrow, and then failed. That would be ideal. But tomorrow's a holiday trading session, so we'll see how that plays out. But anyway, that was just a big focus for me. Popping over to the actual market. So the market pretty much opened flat, if I remember correctly, and it pretty much closed flat from the SPYs. Qs were relatively strong all day. They closed up about 0.2% or so. The IWM was relatively weak all day, also closed basically flat. The TLT, which we're watching hyper closely, managed to close green, closed well off of lows, well off of pre-market lows. So giving the market a little bit of a sigh of relief perhaps on bonds, but I think you want to see this thing above 85 to really feel more comfortable. So today was an interesting trading session. We kind of talked about a couple potential outcomes for this market today after yesterday. We kind of talked about like a technical outcome for someone who just administrators that do this, and it's not my approach, but I don't hate on it either. Traders who are just 100% price action. I don't want to know a headline. I don't want to know what CNBC is saying. I mean, personally, I don't want to know what CNBC is saying either. I don't watch CNBC, but I like knowing the headlines. I like knowing the flow of the news, and when Trump or Powell or whoever says something that's market moving, I like to be able to have that in front of me. But someone that was purely technical, you'd be looking at the area to 580. 580 was the pre-market low, by the way, exactly 580, saying this is the technical area where I should begin to look to buy the dip. There's pretty big support between 577 and 580. If you lose that, there is a gap to be filled, but you got another big layer of support between the 21 EMA and 570. It's like 570, 350 to 570 is another big potential zone of support. And that's the line in the sand, right? This market is technically bullish provided that we stay above 170. If you lose 170, then I would say that this market goes to neutral or potentially even bearish technically at that point. But for the moment, these technicals are bullish. And I've been whining and complaining every day about how this market just won't give us any technical setups. It just keeps going up and up and up, and it stays extended. And we got short-term tactical in the extreme zone 5 days in a row, and for 6 days in a row or even more. The market was more than $10 extended away from the 8 EMA. There's just no setup here. And if you're a bull in the market, the pullback is the beginning of the setup. And it could be a shallow pullback to as little as we got today that then resumes the rally. Or maybe it turns into something more, but you're coming down to the area where you want to potentially look for longs. So that's one side of the story. The other side of the story is that we had kind of a big deal situation yesterday. And then the pre-market price action today, I think was the most interesting price action of the entire trading session. So yesterday, everyone knows by now, we had a treasury auction that did not go well, right? And TLT got smoked on it. We lost the big $85 support level. And when that happened, it also really started to negatively impact the market at 1 o'clock. It just completely changed the profile of the market, which prior to that point had the same underlying bid to it, and then got wrecked and they sold it all the way down. So On top of that, this morning, we saw the tax bill get passed through Congress, though it still has to get through Senate, where there's some chatter that it might struggle to be able to get through the Senate. And there are a lot of analysts that are out there who are saying that this tax bill is going to potentially dramatically increase the deficit. There, might be other people out there who want to say that, well, the tax cuts actually can be stimulative enough to the economy that you get so much economic growth that it could pay for itself. But most of what I've looked at, which is from Nomura, there was a good chart from Nomura, and also that Wharton thing. I forget what it's called. Wharton does a thing where they keep track of this stuff. They're both saying that the tax cuts will have a large increase up to the U.S. government's deficit. So that's happening at a really interesting time because I've been trading for a long time, 15 years or so just with T3, and over the course of those 15 years, you always hear about it in the background. The U.S. government debt's getting too big. The U.S. government's debt is getting too big. It keeps getting bigger. The market doesn't ever seem to care. The bond market doesn't care. The stock market doesn't care. It doesn't really ever seem to care. And all of a sudden, though, very recently, really over the course of the last couple months, really since the start of the tariff situation, there's just been a new question. And I'm really going to not make this political as best as I can, because it's not me. This is just me describing, the market chatter and what's been moving and influencing the market. But there's been a big conversation on if what's going on with tariffs and the negative implications of tariffs are the potential end of what they're calling U.S. exceptionalism. And you can see that basically in selling of U.S. assets. Stock market, the bond market, the dollar. And one of the interesting things about the April market sell-off was that the April market sell-off was coupled with a sell-off in the dollar and a sell-off in bonds. And it usually doesn't work that way, right? Usually when the equity market sells off like that and we go into the early innings of a potential bear market or whatever, you will oftentimes see the bond market hold in really well because it's the ultimate safety trade, and you'll see the dollar sometimes even go up in those situations. But that's not what we saw in April. We saw kind of selling across the board. So that's been a lot of the chatter. Is this the end of U.S. exceptionalism? And there was a chart that I mentioned yesterday that Mike Reed got into the VTF early this morning that showed what I mentioned in the afternoon meeting yesterday, which is the foreign selling of bonds, right? That chart is negative right now. It's always positive, almost always positive. Maybe a little bit of an exception in like the 2020 period or in a couple interesting bear markets, but right now it's negative. So foreign individuals, foreign governments are selling U.S. bonds right now, and it's coming from a host of things. It's coming from the tariff war and this conversation of the end of U.S. exceptionalism, and it is also coming from, at the same time, us market participants really seemingly starting to pay attention to this U.S. debt, U.S. deficit, in a way that, again, over the course of my career, it's something that's always been talked about, but I always feel like it's been more of an intellectual conversation than a conversation that actually influenced markets. And all of a sudden, it seems like it's influenced the markets. And then yesterday's auction was kind of like a punch in the face of, hey, we're not interested in buying the 20-year at this rate. You got to give us a higher interest rate. And then, circling back to the pre-market price action being the most interesting price action today, when Congress passed the tax bill, which a lot of folks think will increase the deficit, the market popped for 10 minutes and then got smoked. And really what you got to look at is what happened to bonds at that time. Bonds got smoked. They didn't even pop for a second. Bonds got smoked, and it's interesting because if I remember correctly, Trump 1.0, first time he was the president, and he put the tax cuts through. It was a huge move higher for equities. Stock market loved it. They ate it up. It was the Trump rally, and we really ripped higher on that. And this time around, there's a couple of things you could point to. One, you could say that it was already priced into the market, and I think that that is a very realistic conversation to have. That this was, even though there was some chatter about different sides of the Republican Party fighting over what they want, and it's not getting done right away, this is going to happen. So partially could be priced in, partially could be, well, we're not really there yet because it's got to get through the Senate also. And I read at least one analyst this morning that said that that might be a few month process to be able to do that with some back and forth. But all the same, what we saw here was bonds really sell off on this potential tax cut that boosted the equity market the first time around he did it in just a huge way. And now it's like, oh yeah, you're gonna implement these tax cuts that are gonna further increase the deficit. Did you not see how we, just struggled to get this 20-year auction done yesterday? And then that is going to increase the deficit, and it's going to make people less interested in owning U.S. bonds. Bill Kay posted a chart this morning that said right now the United States government is paying $1 trillion a year just in interest payments on its debt, and you're going to implement a tax policy that has the potential to add on several trillion of the deficit. Again, just going based on some of the analyst data that I've read, and the market initially here at least seemed to confirm that thought process of we can't be doing this right now, and sold down really hard. And the interesting thing is that, and this is what I was wondering also in the back of my head, thinking about the implications of the policy behind this tax cut. I'm like, could it be possible that deficit spending is good for the stock market, right? I mean, that's pretty straightforward. Deficit spending is good for the stock market. It might not be good for the long run of America. You might make the argument, probably correctly, that you're hurting generations of the future to provide for now with deficit spending. But regardless, deficit spending tends to boost the market. So in my head, I was like, all right, well, this tax bill, just like the first time around, could be a huge move higher for the equity market, but it'll be interesting to see if what the bond market does can potentially outweigh what the stock market does. So lo and behold, we see the bond market sell off, interest rates move higher. We get a 10-minute move higher in the equity market that then begins to also sell very hard with that bond market. We got a $4 down move here, all pre-market very quickly. We did find support at 580 and then work our way up. But the bond market recovered. It really recovered, and it not only did it bounce back, it was able to recapture the high of the starting point, which is always key. So maybe market participants are like, we still believe in the good old USA, and they bought it back, and at those rates, they're willing to buy bonds. I don't know. So we did get a bounce back. Like I said before, I don't think that bonds are out of the woods because they're still below $85. They were, for what it's worth, extended to the downside down there. We saw with the Goldman Sachs note this morning from Pat's note that 5% is probably a really important rate now for the 10-year, but greater than 4.7% by the end of May was the more important thing. And this was actually, I'm going to bring the note back up because this was really important, I thought, because one of the things I've been talking about for years, just anecdotally based on what I've seen in my own trading about, we're always asking ourselves, how does the bond market impact the stock market? How do interest rates impact the stock market? And it's an interesting thing because it's not always the same. Sometimes lower interest rates make the stock market go up. Sometimes higher interest rates make the stock market go up. Sometimes lower interest rates make the stock market go down. Sometimes higher interest rates make the stock market go down. It's very dependent on the situation in which that's occurring. What's causing the interest rate move tends to be the story that leads to how the stock market is impacted, and that's something that's constantly changing and constantly adjusting. We need to keep our finger on the pulse of how bonds impact the stock market. Right now, higher interest rates are hurting the stock market. That's the current theme. But the most important thing I took from Pat's note was just substantiating the anecdotal evidence that I've always seen, which is, I'll just read this whole part again. What level do yields start to put real pressure on the stock market? The easy big round number is the 10-year at 5%. The more nuanced answer is greater than 4.7% before the end of May. As is the important sentence, as velocity of move in rates matters much more than absolute levels in regards to impacting stocks. When the 10-year yield has moved higher by 2 standard deviations within a 1-month period, the stock market comes under pressure. And that's what I've always talked about more than anything with the bond market. What impacts the bond market more than anything else, impacts the stock market more than anything else from interest rates, isn't just higher or lower. It is higher or lower depending on the narrative of the moment, but it's the rate of change. Fast rates of change, fast movements in the bond market in either direction have a destabilizing effect on the equity market. So Goldman says, watch that 4.7% level on the 10-year through May, because the velocity will be fast enough. Otherwise, watch the 5% number. So we'll see. Then, the market has an incredible rally. The Qs in particular, pre-market, fully reversed their opening down move as bonds bounce back. That makes sense, right? We understand that higher interest rates disproportionately impact the IWM to the downside, because Apple doesn't need to raise money, right? Apple doesn't need to raise money. They raised, I don't remember the exact numbers, but I remember when it happened in 2020. I remember that headline hit. Apple raises, I think it was $40 billion. They sell $40 billion of, oh, no, it's bigger than that. It's much bigger than that. It was 40-year notes. Whatever. I think they raised like a couple $100 billion or something like that. I don't remember what the number was, but I know that it was 40-year notes, and it was at like a under 2% interest rate, which is just mind-blowing. And they issued that paper. Apple doesn't need, and they didn't even need the cash when they issued the paper. They just did it because they could, right? And that's something that Warren Buffett, I know, says. Don't raise money when you need to, raise money when you can. Raise money when it's advantageous to you. And Apple, Tim Cook, certainly got that message in 2020. They didn't need the cash. They did it anyway because they could. And now when interest rates are significantly higher, they're good. They don't need to issue any paper right now. They're fine. They're a cash flowing machine, and they still got that last paper that they issued. But the IWM stocks, a lot of times they need to refinance their debt. They need to do it at higher interest rates. They don't have 40-year bonds because a bank's not going to give them a 40-year bond, and they are disproportionately impacted. So we've actually seen in the past in other markets over the course of the last couple of years that, like, I don't remember exactly when it was. I'm sure it was at some point over the inflation scares that we had in 2022 and 2023, where we were getting bond market movements that were scary and they were impacting the stock market, but you would see like the stock market getting hit, but Apple going through the roof because everyone was just throwing their money into Apple because it was the safety play because they don't care about interest rates. Yeah, I mean, bottom line is that relative strength came back in the Qs pre-market, and throughout the day today, today was a boring day. It's an inside day for the Qs. It's not an inside day for the SPYs by a little bit, but it was primarily sideways price action. Today was interesting today. I need some sleep. I got up too early. Today was interesting today because it felt to me And I literally said in the morning meeting, like, I don't care about a trader's feel. I want the evidence. I want the facts. I want the data. It felt to me like this market wanted to go down. Um, and it just couldn't go down. But guess what do we know? What do we know? The never ending bid is still present, at least through this week, right? The CTAs, they don't care about anything I just talked about. They need to buy $2 billion worth of stock today in the SPX. The corporate buybacks, they're buying their stock. And it just seemed like all day today, like we couldn't really break out either. The market was running into sellers. There was a couple times where I was like, oh crap, especially looking at the Qs. I was like, oh crap, like I'm looking at the Qs. I'm looking at like Palantir's run here. Tesla at certain points today was wild, relatively strong. I mean, these names basically fully negated yesterday's sell-off. And I'm looking at the Qs trying to break up on a couple of occasions, and I was like, man, are they really going to run this market back up through 1 p.m.'s high yesterday? Is that really going to happen? And it didn't. We would run into some selling that ended up having us as a range day. But within the confines of that, to me, it just felt like this market wanted to go down, and and it couldn't because it was running into that bid. And then all of a sudden, what happened? What do we know? How many times have we seen this happen over the course of the last few weeks? Um, we have been driven up by this wild positioning rally of systematic buying. Corporate buybacks turn off in the last 30 minutes. Systematic strategies turn off in the last 10. Look what the market did in the last 30. That is like that's the real, like, to me, that's like the real movement of what the market wants to do, is when the systematics are gone. And then we had a pretty heavy sell-off there in the last 20 minutes to, at the end of the day, I never want to overread an inside candle with a small range, but it's not a healthy looking candle. There's an upside tail to it. We kind of closed at lows. SPY is pretty much the same thing, though not an inside day. An upside tail to it, not a healthy close, selling into the close. And I'm curious to see if we can sell down further tomorrow. Um, Monday's a holiday, the market's closed. Fridays before a longer holiday weekend like that tend to be slow trading sessions. So we'll see what. And if anything, I would think a slow trading session is bullish because the robots don't go on vacation and they'll still be around tomorrow. But there might be less of those real sellers that we're seeing that sold the market down into the close tomorrow. So maybe it's just a boring day, or maybe the systematics drive us up, or maybe the week close, the real sellers coming into that close actually give us downside continuation that tests some deeper levels of support. And that led to the other part of the question from the morning meeting, right? Circling back to what we said in the morning meeting. Technicals look great. Technicals look like a long here. They look like you want to buy the dip. Where's the buying opportunity? But this bond market, if it really implodes, which it held in great today, by the way, could act as like a gray swan type of an event that drives this market lower. So, we'll see how we gap tomorrow. We'll see how it plays out. TLT had a fantastic. The other thing that's interesting is how well TLT recovered today, and that the equity market actually stayed heavy. So that is the other thing that I thought was particularly interesting. You would almost think that we would have had a stronger, better close, a better afternoon, given the bounce back that the TLT actually gave, but we didn't. So yeah, that's all that I've got. Happy to turn it over to you guys for some questions, and then I really want to take a nap or something. Just up way too early. All right, what do we got here in the VTF? We got some earnings reports after hours. Decker's getting smoked. Ross Stores getting smoked. I don't see the actual earnings reports, but both names are getting hit really hard here. So that's interesting. It's interesting because they're retail names. I keep watching these retail names really closely for further hints of the tariff conversation. From Greg. 10-year goes out at 4.54 after topping 4.6. Interesting. The Japanese bonds 30-year high was The 30-year high was 3.17 previous. Had closed at 3.145 yesterday. The night session there, which opens at 3:30 a.m. Tokyo time, or 2 hours ago, has it trading now at 3.182, which is a new high. Yeah, that's the other thing that we got to watch. I am not an expert on that carry trade, and somebody asked me about that carry trade recently. Again, just really, you know, I definitely still have some knowledge limitations that I'm working on, and I'm still learning about some of the FX stuff and how that kind of works a little bit with the carry trade. I obviously learned a little bit back in August when it impacted the market, but it's something we got to pay attention to. Though my initial thought was this move in August blew up so many people and so many companies, and I mean firms and stuff that were involved in the carry trade, that I would think that they would be so recently after that happening, uh, better at the risk management on a potential blow up there. But it's something we got to pay attention to also. Let me just read the rest of Greg's notes before I read Dave's note. Convexity in bonds is like compound interest in reverse. As rates go up, it gets more expensive on a floating rate basis to borrow to own them. Okay, yep. Interesting and profound as well, hence the velocity effect. Also from Greg, but per Dave S. per Anthropic. Global bond market is approximately 130 to 140 trillion dollars as of 2024. The U.S. equity market approximately 50 to 55 trillion as of 2024. I wouldn't have thought so. Yeah, so this makes the bond market roughly 2.5 to 3 times larger than the U.S. market, U.S. stock market by total value. I actually would have thought that that was even bigger. I would have thought that that was an even larger spread between those. Breaking this down further, U.S. bond market specifically around 50 to 55 trillion, making it roughly equivalent in size to the entire U.S. equity market. That's interesting. I didn't know this. I actually thought that the U.S. bond market was bigger than the stock market. I would have guessed that the U.S. bond market alone would be double the equity market, but that would have been my guess. I would have been wrong. The U.S. represents about 40% of the global bond market. That's great info there, Greg. Thank you. From Dave S. Isn't it the case that the bond market is many times larger? Oh, here we go. Than the stock market, and will be the one in the driver's seat most of the time. So Greg just gave us all that data, which is awesome and appreciated. Thank you, Greg. Um, People, it's always been a common thing that like the bond market is like the smart market. There's an expression, I don't remember what the expression is, but there's some sort of a market trader expression or whatever about the bond market being the smart market and the equity market being the dumb market. Um, that the bond market's like the tail that wags the dog of the equity market, but I've never necessarily believed that to be the case. I've always felt that markets just kind of move hand in hand with one another and they have influences on each other. But yeah, Greg just gave us all the data. Do the CTAs hate money? The CTAs are doing great. Look, the CTAs are doing great. Someone asked me in the YouTube yesterday about performance of hedge funds through the year. I don't pay close enough attention um, to that because it's not my return. So I don't really care what hedge funds are returning. I care about what I'm returning. I care about the data, not about the return of others. So I don't look at those numbers super closely. I do see them, and I'm pretty sure that CTAs are making money this year. And I mean, just think about it. The CTAs were fully out of the market and net short by, I'm not exactly sure where in the SPYs, but probably by like 560, 570 on the way down here. CTAs were out of 100% of their longs and had flipped massively net short. So they were net short for this entire down move, and they're trend following. And then they were like 100% net short, so they weren't continuing to add down here. They were big sellers here, not impacting here, just were short. And then on the way up, they started becoming buyers, I think somewhere around April 21st or so, which was uh, where we started to really call for the positioning squeeze to the upside. That's why we called for it. So then there were buyers really starting here. So yeah, there's still buyers here, but they've been buying. They were out of their longs and net short from here, and there were buyers starting from here. And yeah, they might still be buying here now, and maybe that ends up being the top, and that does end up being that way. But these guys, they make money net overall. They make money, or otherwise this wouldn't be happening. So they definitely don't hate money. Um, TLT's edging higher a bit after hours. Google's reversing its entire move. Hey, Google was sick again today. Google, like some of they were. That's a couple of the other names I mentioned. Palantir and Tesla's strength as having me nervous about the Qs fully reversing, and it wasn't just them. Google was insane. Microsoft was insane today. These things were driving the market up, but yeah, they pretty much fully reversed. So we got a pretty big upside tail on the daily chart in Google. Almost looks fake. Microsoft as well. From David, where did you have your mental stop loss set at after you entered your CRWV trade pre-market based on the daily or the 5 minute? Was curious for learning purposes. I didn't have a mental stop. I often don't trade with stops. This harkens back to something that I talk about a decent amount in the VTF. I talk about like two ways of trading in these meetings now. I talk about what I think the right way for most people is to trade, and I talk about what I do. I used to primarily only talk about what I thought the right thing for other people to do was, and significantly less about what I do personally, because they don't always match up. And I'm just being honest about it. It's just kind of where I'm at with my trading career, where I've done well enough now where sometimes I feel like it's funny. I remember like one of my old senior traders when I was like a younger junior trader telling a different younger junior trader a statement that at the time I did not understand at all. And now I think it completely applies to my trading. He said, when I trade, a lot of the times I'm not really trading stock. I'm just trading money, and I didn't understand that statement at all. And now I do. When I was a newer trader, I was trading stock, and that means that I'm doing all the things that I am a proponent of other traders doing, that I preach about all the time. How to execute, how to put a stop loss, how to manage risk on that, how to maximize reward, and the way that I trade now is more about I trade money. So it's more about like how I'm managing this money, how I'm building into and out of positions, how much am I down versus where it is in the moment. Um, like the market just always kind of is where it is, and my position is what it is when the market is what it is. That sounded crazy what I just said, but I'm just trying to like get this across the best way that I can. Where I don't look at like when CoreWeave was high at highs and I was shorting it. Keep in mind, I was also swinging it yesterday. Um, I was down a lot of money at that point. That's why I got out of bed. Like I kept a decent position overnight. I wasn't light overnight. So when I saw like this thing trading at 116, 117, I was like, oh crap. And my brain was tired, but I was trying to do the math in my head on the position that I had last night and at 117 how much I was going to be down while I was walking up the stairs to my computer. And when I turned the computer on, I was down a lot of money. But what I mean by, at this point in my career, I trade money, I don't trade stock, is when I turn the computer on and I see the number that I'm down, that just kind of like is what it is in that moment. I don't really know how else to describe it. So it's like I can just hit out and realize a loss because it's past a stop loss or something like that. Or I could say to myself, like, based on where this is trading and how it's trading and where it's located and how much I'm down, like, what is the right thing to do to maximize my account, to maximize my money, to maximize the trade? That's what I'm kind of asking myself more in any given situation than like buying the breakout and putting the stop loss in and losing $100 if the trade doesn't work. Not that there's anything wrong with that. I actually think that that's how you should learn how to trade. That's trading correctly. That's what I preach in my training program classes. It's what I preach is the right thing to do in meetings. Like if you asked me, if you phrased your question differently to me, if you said, "Hey Derrick, I was in CRWV pre-market at this time. Like where should my stop loss be? How should I trade it?" I'd be giving you a very different answer. But it's not what you're asking. You're asking me about what I did, what I'm doing, right? So I'm giving you an answer of what I did and what I'm doing. And what I did and what I'm doing is not right for most traders. And that's why I always tell people, like, take the ideas that I provide, the information that I provide. Please don't just follow my executions when you see like little green and red lights pop up on the positioning thing that's in the VTF. Like please don't follow that. You're gonna probably blow your account up if you just follow that. You don't know how much I'm buying or selling at any point in time. You don't know how big my account is, how much I can afford to lose. You don't know any of that. You can't just follow what I do or what any other trader does. You have to do what you're gonna do. And again, for me, it's like I'm down all this money. Stock basically touched 120 pre-market. It's at like 116 to 117.50 with a really really wide spread right now. But it's day 5 to the upside. I'm down the amount that I'm down. What I'm doing is I'm adding to my position, and I'm gonna manage it. So I also don't like when I take a loss in a position at this point in my career. So I mean, look, I still do take pure day trades where I buy the stock, I put a stop loss in, and I take my loss. I still do that. It's just not the majority of what I do. That's a minority of what I do. The majority of what I do at this point is building into and building out of positions. And the way that I manage risk on that, if I'm wrong or I'm early or whatever, um, is I will build out of the position for a loss. And I actually was forced to do that a little bit, uh, like late last week and early this week, because I was too early on shorting, too heavy on shorting, and while I was expecting a positioning squeeze and I have longs on at the same time, my whole game plan, if anyone remembers, because I'm a big stickler in game planning, and I've been talking about this every day, um, on April 21st at this low at 510 at 508.50, I was 100% long. I was 100% long. And my game plan was at a certain way on the way up, I'm going to be building out of my longs for a profit and building into my shorts. And I'm fine. I'm fine if we go from 550 to 570, making even more money on my longs while I lose money on my shorts. Because I think that the positioning squeeze will lead us up to, like, at the time I was saying the range between 560 and 570, maybe even the 200-day at 573. But we didn't go to 560 to 570. We went to 595. That extra $25 and change of upside was beyond what I was planning on risking, what I was willing to risk on the shorts. So started out great, and in April making a lot of money on those longs, starting to slowly build into shorts, still making money on my longs. I finally got net short. I forget exactly where, 550 and change, 560, something like that. But then very, very quickly, I was getting more and more massively short, and I got myself into a couple extra positions that I probably shouldn't have gotten into that greatly, quickly increased my short exposure, and they happened to be really, really strong names. So then at a certain point when the market overshot my expectation, my upper band of my expectation by $20, $25, I was forced to I took losses a little bit up here on some of those shorts. But the way that I massage those positions, just the way that I trade, is I build into the loss basically, where I go from getting heavier and heavier and heavier on the short side on the way up per the game plan to at a certain point we're going up, but I am staying equally as heavy, but into the down moves I'm selling. So that means that I'm actually selling for a loss into the down moves because I didn't do the next ads. And that basically happened at highs. And then I was saying to myself, like, all right, every time something makes a new high that I'm short, I'm not that basically means I'm going to be realizing some degree of a loss. I'm not realizing it with a stop loss at the high. I'm realizing it by not getting heavier on the short and then covering at the increments on the downside that I would have covered at had I gotten heavier, which sucks. I really wanted to keep the positions. I really have been kind of believing that this market is gonna give a bigger rollover. But guess what? I'm wrong sometimes, right? I'm wrong sometimes, and if I don't manage my money when I'm wrong, then I'm gonna end up not having any. So, uh, do I want to start taking those losses up here at these highs? Basically, no, I don't. But the flip side is, if I was a trader that just used the stop loss, I would be 100% out of my shorts maybe at 590. And instead, every single day that goes by, I'm continuing to work these positions. And now that we've gotten this like 2 day ish pullback in the market, I've been able to regain a lot of the P&L that I was losing on that short side. Again, still realize losses up there. That's gonna hurt. It's gonna hurt. I'll tell you where that's gonna hurt me. It's gonna hurt me if we roll back down to SPY 530, which I don't know if that's going to happen or not. But if we roll down to SPY 530, that's where it's going to hurt me because I took partial losses of positions in the 590s, which also means I'm going to have less stock on the down moves, and I won't have as much stock for as big of a move. That's where I'm going to get potentially hurt. But whatever is what it is. Part of the business sometimes to have to take losses. I try to never do it. But yeah, I mean that's kind of what I did with the core weave today. Did you find yourself having to adjust your game plan dynamically, such as a name like core weave, depending on the stock, personality? Yeah, so kind of did already answer that one. I'm not necessarily changing or adjusting the game plan dynamically. It's already kind of built into the game plan on every aspect of it, including how I will take a loss at certain points in movements. So, I'm a big believer in just having your game plan for every trade that you take and following that game plan to the letter of the law. But the game plan includes reward maximization and risk management, right? So I know that at a certain point, if a stock or a market moves too far too fast against me, like the spies and the Qs have, I know that at a certain point I go into risk management mode, into loss realization mode, and minimizing that loss. And potentially, the way that I do that, um, I'm still open to making money in these trades. I'd have to really sit down and do the math on after what I took the losses on, how much I could make, and all that stuff. But if I still have the position on, it means I still have a fighter's chance of making back when I'm down in it. Which I got to be careful with that language because I preach all the time correctly that you should never focus on making money back. I'm not focused on making money back. Again, it's just that inherently, if you're down money and then the position improves and you get stopped out, you are making money back. The goal isn't to make money. That'd be the right way to say it. The goal is not to make money back. The goal is to trade the trade, and as long as I'm still in it, then P&L can improve. Whether that's going from negative P&L to less negative P&L, or to positive P&L, or to more and more positive P&L, which is what I typically prefer. I typically prefer positive P&L to become more positive P&L. from Kit Kat. CTA being trend following, does that mean they also are doing technical trading in a sense? I don't know the CTA trend follow. So CTAs, first of all, I think implement more than just trend following strategies. There's different cohorts of systematic strategies that we pay attention to, right? We pay attention to trend following, we pay attention to vol control, we pay attention to the one that I always forget the name of, um, including right now. But with vol control, like I know what the rules are because we talk about them enough and we get the data enough about adding on and reducing based on realized volatility on 1 month and 3 month lookbacks. I don't really know what the full CTA trend following rules are for when in the point in the trend they buy and sell. I don't really think it's based on technical analysis per se, but it is some degree of like, and we see it with the Goldman Sachs notes of they're gonna, like the triggers, right? The triggers that are gonna trigger CTA buying or selling at a greater level. So you're not 100% sure. That's a good question. Yeah, if you were gonna trade it, David, I would say don't trade insane stocks at 4:05 a.m. That's what I would say. Over to the YouTube from Robert. How did you calculate your risk in CRWV that early in the pre-market? Did you calculate versus a pre-market high? What if the stock would start to squeezing up in the early pre-market with lack of volume that early in the pre-market? Yeah, I think I answered that one already. Kind of told you how I do it. And the downside of trading that fluidly is you can't always fully calculate exactly what you will lose. It's not like if you have a stop loss in, how much you're going to lose. Like, all right, maybe it could be a little bit of slippage, but like I bought 1,000 shares, my stop loss is down 10 cents from where I bought it. I'm going to lose $100 if I get stopped out. But trading with that build in, build out process, I never fully know what I'm going to make, and I never fully know what I'm going to lose, to be honest. But the math works out. From Ryan C. When did you switch to your averaging building in strategy? Was it recently? No, I've been doing like a forms of this probably since like 2018 or 2019. This is not all I do, right? Like I do take technical trades and things like that, but I've talked about this in other afternoon meetings, I guess just not for a while, and I'm not going to get into too much detail today just because it's getting a little bit late and I'm just really beat. But I could get into it in another afternoon meeting again at some point. Basically, it just started with the idea of like if you take a basic breakout, I'm just talking about reward game planning, right? And I've done this in afternoon meetings where I've like pulled up like charts where I've done it with trades and we can kind of calculate like how much is gained or lost or whatever. But I don't know. I'm just gonna try to make up an example by picking up by choosing a random stock. I'm gonna choose something that moved better than that. All right. I'm just gonna try to make up an example and give like a basic overview here. Let's say, I'm just making this up, 336 is a breakout for Tesla, okay? And the trade happens and you buy 336. And you use the stop of the low of the bar. It's got higher volume, looks like it'd be a good stop. And the low of the bar is 334 spot 98. I'm just gonna say 335 to make it simple. So you're buying 336 as a breakout, 335 is a stop loss for Tesla. You have a dollar worth of risk. If you took 1,000 shares and had $1 worth of risk, you'd be risking $1,000 on it, right? So that the risk is covered. And we're going to say that you're buying 36,000 shares, you're putting your stop loss in at 35. So one of the things that people on the team have been around for a while know that back in the day, probably should have been getting friends or getting hobbies or something like that. But back in the day when I was training and fighting professionally, Friday night was always my big sparring night, and 7 to 9 p.m. or so. And then after my big sparring night, instead of going out on Friday night, I would go home. And if I was not in training camp, I would usually grab a beer. If I was in training camp, I wouldn't. But I would turn the computer on and I would pull up a blank Excel spreadsheet and I would start to play with game plans. Because what else are you gonna do on a Friday night when you're in your in your late 20s, right? Except pull up a spreadsheet and play with game plans. And and this is something I encourage people to do. This is how you'll learn your game plans better, right? This is going to make you a better trader. Um, you can now all right. Now let's assume that the trade works, and it worked today. Okay. Think about all of the possible scenarios that you could have implemented to maximize reward. Like, think about all the different ways in which the trade could work or fail as well. So, um, one of the things I talk about, like in my training program classes, is the idea of selling 50% of your position and 1-to-1 on your risk, so that if the trade fails, you lose nothing. That's one example, right? So I bought 1,000 shares at 336. I sold 500 at 337. Now let's assume that the trade, we don't know what's going to happen next. Okay, trade fails, I'm break even. I get stopped out, I'm break even. I get stopped out of 500 shares. I booked $500. I lost $500. I'm break even on the trade. But now let's assume that the trade continues. I got this other 500 shares. What am I going to do to maximize reward? Well, you got options. You got different options on what you can do. You could implement trailing strategies on whatever time frame, on a 5-minute time frame. You could have trailed off of this pivot low, and then 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 eventually got stopped out in the end of the day when the market rolled down really hard. So you could implement trailing strategies, and you could do it with the entire position. You could implement some sort of incremental selling strategy. All right, I sold my 500 shares at 337, so now I'm going to be break even no matter what. I got 500 left. I'm going to sell 100 shares every dollar. Okay, so I book $500. 338, I sell another 100 shares. That's $200 additional reward. I booked $700. 339, I sell another 100 shares. It's $300. So now I'm at $1,000 reward. 340, I sell another 100 shares. $400 realized on that sale. I'm at whatever I just said, 1,400, etc. You're out of the trade. You do the math on it. Okay. You could do a combination. You could say, I'm going to trail 300 shares and I'm going to offer out the other 100 shares every $2 just to book extra profit. Or you could use a previous resistance level as a target. You could use an equilibrium zone as represented by a moving average as a target, right? All these different game plans. Well, one of the game plans I dreamed up one night after a good few rounds of sparring and, hanging out by myself with a spreadsheet on a Friday night was, all right, well, what if after I book this profit, I kind of do the strategy that I was talking about selling 100 shares every dollar, but I also rebuy it every dollar down. So now let's think about that, right? So now you have all these different situations on now how this type of a game plan could play out. Some of those situations will make the reward less than it would be. Some of them would make the reward more than it would be. Like let's say you sell half at 337, you sell another 100 shares at 338, and then that's all you do, and then you get stopped out, right? You end up making $200 on $300 on the trade, I think, right? Because you're losing 400 after you book the two, and that's it. Hold on, let me actually do that math. So hold on, you booked 500 at 337, so you'd be break even. You sell another 100 shares at 338, so that realizes $200. Then when you get stopped out, you're only losing 400. So you made, because you only have 400 shares, right? On the other 400 shares, you're losing 400. So you made 500, Then you made 200, that's 700. Then you lost 400. You made $300 on the trade. Now, let's say that the 100 shares I sold at 338, I rebuy at 337, and then the trade fails. Okay, so in that situation, I would end up making $100, right? Because you sell the 500, you sell another 100 up here, so now you've realized $700. You rebuy that 100, and then you get stopped out of all 500. So you basically just keep the difference between the sell at 338 and the buyback at 337. You made $100 in the trade. In that instance of what I just described, by rebuying at 337, I made less money than if I didn't rebuy at 337 and then I just got stopped out. But what if, here's a different situation. What if I sell at 338 and then the stock ranges between 339 and 336 for the rest of the day? That's a plausible situation. So maybe what ends up happening is I sell 338, I buy 337. I sell 338, I buy 337. I sell 338, I buy 337. Once I've sold 338 3 times, if the trade then fails, it's the exact same P&L as if I sold the one time at 338 and then the trade failed. But what if it worked 4 times before it fails? Well, then I would make $400 instead of the $300. What if it went range bound and that happened 8 times and then the trade fails? Well, then I make $800 instead of $300. What if I do that across the board with all of my 100 shares at every additional dollar? Selling at 338, 339, 340, 341, 342 until I run out of stock. And every single time there is a movement of $1, I'm able to put an extra $100 in my pocket. And I get a much larger range, and it lasts all day. And then I end up keeping the position, and it lasts all day tomorrow. And then it fails, and I make $3,000 in the trade because that's how many times I was able to buy and sell. I was able to buy and sell 30 times at $1 increments of 100 shares. That's a failed trade that now just, instead of making $300 with that one sale or whatever, I just made $3,000. Well, what if what I do is I take that extra $3,000, I put this trade on, and I was willing to lose $1,000 from the beginning, right? What if once I get my risk covered, I am willing to lower my stop by the amount where I can continue to do this strategy, but without ever going negative, right? So in other words, going back to the situation that I just said, where over the course of 2 days the stock is range bound, and I get 30 $1 kicks of 100 shares or $3,000. If I had, let's just say, 1,000 shares, right? I'm doing this with like 1,000 share core position that I'm building in and building out of. Well, what's the math behind now if I still am willing to be break even? If I get stopped out at 335, I'm not break even. I made $3,000. If I have 1,000 shares at 334, and then I get stopped out instead of 335, then I make $2,000. If I get stopped out at 333, I make $1,000. If I get stopped out at 332, I'm break even on the trade. Now, what that's not assuming, which you need to assume, I'm just making it slightly more simplistic, is that if I'm doing, so basically what I just described is I can take the money that I made by working that type of strategy, and if I'm willing to give back everything that I made, which is an if, it's not always going to be that case, but if I'm willing to give back everything I made, I can reduce my stop over time from 335 to 332. And that wider range can let me continue the strategy where, really you need to do, the math is slightly more complicated because you'd be sizing up by continuing to buy at 333, 334, 332, 333. So you really, because you're sizing up, the stop wouldn't actually be 332. It might be 332.70 is the break-even price because you're adding in order to keep the range going. But again, this is why you need an Excel spreadsheet to play with the numbers to figure out the game plan. But then, what that can do is that can expand things over time. So in CRWV today, between my swing that I was getting smoked on and the adding of stock that I did up here, my break-even price at that point, I calculated the math real quick, was like 110. That's where I would be break-even on. I was down money, right? I swung the position, it gapped largely against me, but I averaged up. So with that, my break-even price was 110. What I was doing here and the way that I traded this is kind of as I just described, where I was doing this with 100 shares every 50 cents. And so basically what that means is every single green dot that you see on here is me putting $50 in my pocket. And what happened was my average price was moving higher, right? My break-even price, I should say, was moving higher. Immediately pre-market, I needed this thing to get to 110 in order for me to be able to be break-even on it. I remember somewhere in the morning, actually, it wasn't even the afternoon, when this thing was trading at like 112.50, I was break-even in it. And the more time that goes by, again, this is not a good situation because I was down money to begin with. But if you circle it back to kind of what I was just saying with Tesla, as time goes by, with the trade here, my average break-even price can get lower and lower and lower and lower. That can enable me to widen the time of the trade to give myself more room to be able to make more and more money over time, right? So this is all off of Ryan's excellent question. So what this all then circles back to, I guess, in part of my evolution as a trader, is I'm a technical trader. The stuff that I teach in like my trading 101 game planning classes that traders get access to when they first get started, I stand by all that. And it's still what I implement in my trading. I still, buy that breakout. But the way that I like to game plan most trades these days is more of what I just described right now than what I used to do back in the day of pure trailing or pure just selling incrementally or some combination of the two. And I do still, on some trades, do those things. But I love the reward profile that can build out over time with what I just described. Because what I just described means if I take a trade and the trade goes in my favor, if I buy a stock and the trade goes in my favor, it goes up, I make money. If I buy a stock and the thing goes sideways, I make money. And that a lot of people don't do, right? If they're really good, they might make a little bit or they might be break even. For me, I will take a position that I'm in moving sideways all day, every day. The more volatility in the sideways nature of it, the better. I'm going to make more and more money. It also means that I can even have positions go against me and I can make money if the rate of the amount of money that I'm able to make on the sales that I just described is greater than the P&L that I'm losing by my tier size of the position moving against me. And then that all circles back to the idea of Robert's question, I think, or someone's question that led to me talking about that senior trader back in the day saying to me, I don't trade stock anymore, I trade money. And that's when then I'm looking at like CoreWeave this morning and I'm going, oh crap, I'm smoked on this position. This thing is super against me on this gap up. What am I gonna do? This sucks. And instead of just panicking and bailing out, I'm just like, all right. The reality of the situation is it's where it is, and I'm down what I'm down. And it's up huge, and I like the technicals. The technicals are still important. Day 5 to the upside, stupid extension on the daily chart, RDR potential, love all that. Um, don't love being down money in it, but like, what is the best way for me to manage this position? As I'm adding to my position at 117 this morning, there's 3 things basically that can happen. Stock can go down. That'll be great because I just averaged up at a great price and the stock goes down and I make money. I make it what I'm back. I make what I'm down and I make a lot more. The stock can go sideways. Well, then it's a math question if the stock goes sideways, right? How much am I down versus how much money can I make with the buy, sell, cash flow strategy? How many times, if I'm down $10,000, how many times do I need the stock to move 50 cents or I make $50 per 50-cent movement in order to be at $10,000 of P&L? Um, or the stock can go against me, in which case uh, I am in a bad spot, right? I'm in a bad spot, without a doubt. I'm in a bad spot. I'm already down money. I average down further on the position, and it has a momentum squeeze against me. This is why it's really important to understand the stock that you're trading. What I want to say to you is that stocks can't just only and ever go up forever, but they kind of can, and they definitely can for longer than I can afford it. Or you can afford it, or anybody can afford it. Again, I always like to harken back to a couple examples like HKD or JKS when it did that crazy squeeze that one time. But you know, one I can have a little bit more confident that I'm not trading a Chinese stock that has a million share float after a recent SPAC that is being pumped, right? So at some point there's going to be an upward bounce to it. But also, then it goes back to kind of what I was just saying about about how I will manage the position for a loss at a certain point, like I had to do recently in some of my bigger picture shorts because the market extended so much further than I thought that the market was going to extend. In which case, at a certain point, I will piece out of it at a loss. And I did have a game plan on how I was going to do that. Like I was going to start by averaging up here basically because it was still within the confines of where I was comfortable. But at a certain point, if this was squeezing against me, I'm still not going to just stop out, which again, that can be super dangerous. I've had situations where I'm doing this and you're just getting that Palantir heavy volume up move and you're just getting absolutely destroyed. And, eventually those even pull back a little bit and give some volatility as well. But I have, a game plan in place on kind of a maximum pain P&L point. It's also a little bit based on actually the buying power of the positioning size for me, where at a certain point I'm like, all right, I'm not, I can't allow myself to get heavier in this, so I need to start to piece out for a loss, and I do it kind of in the same way, but it still gives me the chance actually to let the trade work out if it eventually pulls, like some of these other names have been doing. All right, that was a really long answer, but there was a lot to that. Yeah, for sure. I'm gonna end the meeting there. Have a good night, everybody. I'll see you all tomorrow.